All right, guys, I'm just back here with another video. Um, Somebody sent this to me. Basically, want to get my reaction to it. It's a guy getting interviewed, Chris Vermillion. Apparently, he's pretty good at predicting bottoms. You know, famous last words, right? But let's check it out. I'll give my thoughts on it and see what he has to say as far as how he predicts bottoms and predicts tops. So let's go. Let's get into this.
Welcome back to Kitco News. I'm Jeremy Safran. Well, the world is bracing for another round of economic shockwaves, this time from the return of tariffs. President Donald Trump's Liberation Day announcement has brought in a sweeping wave of new trade policies, and the markets, they're reacting fast and hard. Global stocks are in correction territory. U.S. markets have seen back-to-back sessions of heavy losses. The Dow is down 1,500 points today after a similar.
Well, this video obviously was recorded a couple of days ago because obviously the market up today, but I think it's maybe a couple days old, so keep that in mind.
Similar drop on Thursday, and the Nasdaq is looking to close in bear market territory. Meanwhile, yields have also tumbled below 4%, signaling recession fears are rising fast. And over in Japan, their prime minister is calling the U.S. tariffs a national crisis, while the IMF is describing it as a significant risk to the global economy and an inflection point for financial markets. And now we have China responding to sweeping U.S. tariffs with retaliatory duties, on all American imports and new export controls on critical rare earths, raising fears of global economic slowdown. And at the same time, President Trump has doubled down on his aggressive tariff policies amid plummeting U.S. stock markets, stating Friday that, quote, "My policies will never change." So where do we go from here, and what are the technical signals that matter now? Joining me is Chris Vermeulen, founder and chief investment officer at the technicaltraders.com. Chris, always great to have you on. Good to see you.
Yeah, same, Jeremy. Always a pleasure.
Crazy day as we can get started. I wanted to get started with the bigger picture, though, because Trump's tariff plan has ignited what many people are calling a full-blown global trade war. China, as I mentioned, has retaliated against Trump's latest tariff with levies on all American good and export controls of rare earths. Firstly, how are you seeing these macro signals before we get into the technicals? I mean, are we in the early stages of a deeper market correction, or is this simply a volatile but tradable
I'm just gonna say that the green screen behind this guy is actually really good.
pullback?
But anyway, that has nothing to do with this, but it's really good how good their green screen is. Make it look like that's a window behind them. Anyway.
I think we're in. I think we're starting to see a major market top. I mean, if you look at some economic data, unemployment and layoffs and all this stuff, and housing pricing, how it's all been moving, it has been signaling for quite a while that the economy is slowing. People's spending is coming to a grinding halt. I mean, based on what most people consider a recession, we're not close to one yet. But when you look at the details and the technicals, the trend has changed from a bullish economy to a neutral to bearish. And the whole wave of tariff is kind of just usually the governments kick the can down the road and try and extend the markets and keep things frothy. Tariffs are more or less just taking the can and throwing it in the garbage, and the markets are just dumping out. And, we're going to see everything in America become much more expensive. Almost everything comes from China. They got massive tariffs, and we got all these other tariffs and other products. So that is not good. That means slowing sales. That means we got earnings seasons coming up. I'm pretty sure we're going to see a big downturn in forecast for earnings for companies. Investors don't want to see that. If earnings are not good for this past quarter, and the projected forecast for earnings is even lower than expected, I think that the tide has changed. We've gone from a bullish environment to, I believe, we're now in a bearish environment. And I think that starts next week, to be honest, is the new kind of bearish phase.
The new Monday, we're calling it. It's going to be interesting to see, of course, when markets are closed. And I mean, Chris, technically, though, what are the most important levels?
So that initial analysis actually is pretty good. Obviously, he's wrong as far as like the new Monday was going to be a bearish day because Trump took off the retaliatory tariffs on a lot of stuff. So market pumped, and then he exempted semiconductors and things that used to create technologies like phones and computers and stuff. So so he was wrong about that. But I like where his mind's at though. I do think we're in a bearish phase overall, but bear market the rallies are fierce. So we're pumping right now, but I think he's going to be. This dude probably ends up being right at some point.
that you're watching right now on the Dow and the S&P 500 and the NASDAQ. I mean, is there any support zones, or are we just in a free fall?
Yeah, there are. I mean, I use pure technical analysis. I kind of weave out and get rid of all the economic data. But when we take a look at the actual price, as investors, we all want price to move in our favor.
All right, so he just said that he uses pure technical analysis. What that means is that he doesn't look at the economic data. He doesn't look at earnings. He's not looking at, the job reports. He's not looking at all these other things. He's looking at purely the technical, purely the chart, the price action, the movement of the prices of the stock or of the market. Now, I'm of the opinion that that'll work on the macro market, on the overall market, because overall the market always goes up. But that's tough to do, and I wouldn't do that when it comes to individual companies. Individual companies' earnings actually do matter with the stock, and individual companies can go to zero. So if you're going to be buying dips or that type of thing, knife catching on individual companies, you better make sure that you're looking at their balance sheets, their income statements, making sure they actually make money, making sure that they're able to service their debt, things like that. That stuff actually matters because you don't want to be buying the dip on a company that doesn't have the cash to service their debt, for instance. So um, I'm mostly a technical trader, 99%, but if I'm buying individual companies, I'm definitely looking at their fundamentals. Anyway, keep going.
Favor. This is the weekly chart of the SP 500, and we have the COVID low down over here. And using a Fibonacci extension, which Jeremy, you and I have talked about and I've shared before, it's one of the most powerful technical tools to project forward where the next two price targets are. And so if we take the COVID low and we go up to this high that we saw in 2022, and then we can gauge the strength of the pullback, we can bring that forward to where price should go. Now, there's two ways. The two targets on here are the 618 extension, meaning the move from this low should be about 61% of this initial move. And we should see the market pause and have a hiccup there. And when we do have a pause or hiccup, we almost always see 100% measured move get hit. And so the SP 500 hit that move, and it has put in this like double top formation. It's clearly being rejected. And so the bullish phase, we were in a bullish environment. Now we're switching to a bearish environment. What happened right here is exactly what's happening, or what happened back over here. And so that's the upside, knowing, okay, we've just slammed our head into the ceiling, and now that trend is done, and now the market needs to digest. So if we drop down to the daily chart, now we can get an idea of where the price should go over the next few trading sessions. And again, we can use Fibonacci extension to the downside. We take the high, we take the recent move to the downside and the strength of this bounce, and we carry that forward. And you can see, as of you and I are recording this today, which is Friday, April 4th, we have now, it came down and closed at the 618 yesterday, and then is sold off, and we've hit that 100% measured move, which also happens to be a pretty major support level through here. We had a very significant pivot low. We had another pivot low. We had a bunch of trading above and below it. So this is a technical level that, okay, the downside is mostly, I think, done for this particular leg. We've got the VIX up like 100 and something percent in the last couple of trading sessions. Everyone's buying put options, betting on falling prices. So everybody's scared. They're liquidating. Now they're betting on falling prices. And they tend to do that always right near a major technical market bottom. And I believe we're probably going to start to see this market have a pretty sharp bounce. I don't think it's a rally in terms of going to new all-time highs. I think it's a bear market bounce. And eventually, I think we're going to go a whole lot lower. And so this is the bias. The NASDAQ is pretty much the same. And the Magnificent Seven are in a bearish environment as well. And today, as we're hitting this technical level on the SP 500, we're seeing the Microsoft and Google. The intraday charts to me are showing signs that there's big buying going on. And I think we're starting to see the Magnificent Seven starting to be accumulated from people trying to pick a bottom and seeing it as an opportunity to buy at a good price because they're bullish long term. And that is a sign. If the Magnificent Seven are starting to firm up a bit, that probably means we're going to have a big bounce starting in the next few sessions. But today is a bloodbath. If we close near the lows on the session, that fear is going to carry through the weekend. People are going to percolate and get more fearful because they can't do anything. We'll probably see a big gap lower on Monday.
Mhm.
and everybody will eject at the open, and there'll be a little washout. And Monday could be a very significant washout low, and that's when the bounce starts. So that's my short term take on the SP 500 and the
Right.
Nasdaq at this point.
Okay, so you said that there's a little bit of
This dude's good. Really good. I love that analysis. He knows what he's talking about. So let's go to one of my charts here because that's kind of what I'm seeing. Like, so this video was made when 9 days ago. So on the what? On Friday the 4th. All right, so that would have been Monday the 7th. When he was talking about playing what will play out. So if we go to the date the week day, let's go to the daily chart on SPY. Monday the 7th, or Friday the 7th, we were where? We were down here. And since that video, looks like Friday the 4th, then since that video, boom, up. So how let's put this in more like simple terms, how he's doing the Fibonacci retracement, right? So first of all, you could kind of say this was already a support area anyway. Look at the chart on the daily and see that this is an area of bounce, an area of interest, right? See that right there. Okay, so some people would just buy that just because it was an area of interest. But what you usually want to look for is confluence, right? You look for, all right, well, is it a major moving average or is it a order block or something like that? Order resistance level, previous high, previous low. So let's do the Fibonacci because that's what he was trying to show. He was saying that based on the COVID lows, the COVID move, how the market was going to move, how to predict the next uh, measured move from the COVID lows. So this is the easier way to do that. I mean, he kind of put it in more technical terms, but essentially what he's doing is he's measuring the move. This is on TradingView. So you go to the left panel. You get Fibonacci retracement. You go from the top to bottom, and boom, that's the measure of the move from the top of right before COVID to the bottom of COVID. So he's using that as the ruler, measuring stick of where the next moves are going to go. So then let's take this and we'll extrapolate it out above COVID highs. Boom. That's about the top of the next rally in 2021, right? So then he says, okay, well you'll have a bottom. So then you take that same measurement and say, okay, well whenever that top gets uh, broken through, the next top is going to be about the same amount. And what do we have here? Pretty much exactly the same thing. You got the top of the next rally above, boom, right here in SPY. So now the question becomes, okay, well, if this is a local top on the weekly, where's on the next bull run, where's the market going to go? Well, if based on this analysis, we put this at top of here, market should run to about 725, 726, somewhere around there on the next bull run. So let's see if we take this and it predicts. Look, it basically predicted the bottom from the top of the other last right. See the problem with this, we're trying to predict a bottom is sometimes they can keep going down. Obviously, nothing's so. And then the question becomes, well, where do you actually put it? When do you actually apply it? Because you could have applied it here, right? Let's say you applied this at this what you thought would have been a top right here. You say, oh, I'm waiting for the market to go down here, and it never did, and it shot back up, and you weren't in the trade. Or you could have tried to predict it and say, I'm going right here, and it never shot back up and going. So it's easy to say it's much easier to do this when trying to predict a bottom than it is trying to predict a top. All right. Wait, no, I said that backwards. We're trying to predict the top when it's trying to predict the bottom. So when you try to predict the top, you can just put this on the top of the most recent high and then say this is going to be the next top. But it's very tough to say where the next bottom is going to kind of make an inference or a guess, say, wow, we're pretty extended, but there's no way to really sure. Because nothing's for sure, obviously. But this is a good predictor. This is a good measured move or measure of the measured move. And I would say that if he's talking about it going lower, I would say that we might hit now in SPY. Let's see here. We could hit down into SPY. 463s. This would be the top of the most of a local top. So we know that resistance becomes support. This is the last major resistance level that was broken through. So I would say that would be back up the truck type level, but we'll see if we get there. Hoping that we do, because I would love to buy more down to these levels. So anyway, that's how you kind of use Fibonacci retracements to predict where the market is going. Um, Not too difficult, but sometimes they can be made sound more difficult than what it really is. But this guy's good. This guy's really good. So let's listen to him for the rest of what he's got to say.
Support there. Some people buying the dip. I mean, let's talk about sector pain because, as you mentioned, tech is bleeding. Apple, Nvidia, Tesla, all really down because of their exposure to China. But now, bank and energy stocks are falling really fast too. What are you watching there? I mean, is there any safe haven out there?
I mean, I think the only safe haven is the best play right now. The one that we moved into, like just before this market was rolling over, we got a sell signal about 16-17% ago. The technicals have been choppy for the past month and a half, and we moved to cash. Cash has kind of been the play, and that's what everyone we've all been talking about. It's so nice to stand on the sidelines and avoid this. Because there really isn't a safe haven play. Gold is holding up very well. Gold is only down 5%, where the rest of the markets are down 15 to 20 or plus percent, depending on the in particular asset that we're talking about. But overall, gold is the holding up the most.
Please don't skip over what he just said. He's in a lot of cash. Cash is a position. Cash is where you can be, which is a safe haven. Cash allows you to buy the dip. So when you're in cash, you're in a great position. Instead of trying to call a top, instead of trying to go into puts, instead of trying to short the market, just go all cash. Cash is a position too. It allows you to buy the dip, allows you to buy at favorable prices, good companies, or just the overall market. So don't try to be the guy who, you can try to be wherever you want to be, but like, this isn't financial advice. But it's tough to be the guy to try to call the top every time. So it's better if you think you're at a top, if you think you're at a inflection point in the market where the market's going to go down, much better to sell calls against your position and start building cash instead of trying to buy puts and predict the market's going to crash.
I still think gold is going to hold its value. It might want to push a little bit higher. My next target for gold is about 32.75. Okay. But it has hit a major resistance area on the chart. When we look back at these price patterns, 3,200 more or less is a pretty significant resistance area. So there isn't a safe haven, and this is a perfect example of why gold is crashing and why silver is crashing and miners. People see them as a defensive safe haven play, but when we are in a bear market and there's actually a pure panic and selling, there isn't much safety anywhere. People can still be in the right position and they still panic and they sell it. Yeah. So the only thing that's really positive today is
You brought up silver there. I want to go back to that because looking at silver today, I mean, it's been wild to watch it. I thought that there was going to be some support around $30, yet here we are.
Man, I know silver. I mean, yeah, silver's got a few pretty bearish patterns playing out here. I mean, it's had these three surges to a high, which when you condense the price and the speed that they go up, this is a very bearish price action. As we know, the markets like to take a staircase up and then they take the elevator down. Silver's known for this. Silver usually has a series of big, long red bars you got to be aware of. They do a lot of damage. And I think this is a sign, like silver's hit its 100% measured move based on Fibonacci. It got rejected this week. Massive volume. So I think the game has changed. I think we've gone from a bullish environment in the stock market and the economy to now we are in a bearish environment. And so any bounce from this is going to be like just an opportunity to, I think, trim off positions because I do think almost everything is going to go pretty much lower. Bonds are acting as a defensive play, and they're coming back to life. I think bonds might be the only one play that could hold up and move higher while everything else kind of dumps out. I think 2025 is going to be difficult for the rest of the year. There will be some big percentage bounces along the way because the biggest rallies happen in a bear market, but they still get sold into. And so it's going to be a volatile ride. And it doesn't matter which asset you hold. But silver is down, oversold at support. And I think the whole market is ready for just a bit of a bounce after probably Monday's washout low.
Right. It's funny. I think you must have got the same memo as Warren Buffett there. You're all cash, huh? That's your play?
Yeah. Yeah. I mean, when there isn't a signal, we don't want to gamble. You don't want to gamble your life savings.
Well, number one, yeah, he's right. Don't gamble your life savings. That's stupid. But like, the host mentioned Warren Buffett. Warren Buffett, for the last year and a half, has been telling everybody, been ringing the bell that he's going all cash, or not all cash, but almost all cash, like 90% cash. When one of the richest men in the world, when one of the best investors of all time is going mostly cash, you want to take note of that, because he knows what he's doing. He sees more that's going on, and he reads more, and he has access to way more information than any of us have. So he's been ringing the bell about going mostly cash for a long time. He sold pretty much all of his Apple, which that was his biggest holding, months ago, way before the market tanked. So there's so many people that didn't take those warnings, didn't heed those warnings, didn't see those signs, and have really taken a bath on this downturn. Uh, it's unfortunate, but you have to be able to take that information and do something with it. You can't just ignore it when guys like that are going all cash or 99% cash.
If there's not a clear signal, just stand aside and collect interest. It's pretty easy.
Let's go back to the macro front for a second, because we also got these strong job numbers. I mean, we had 228,000 back in March, but the unemployment rate kind of ticked up slightly. We know that this isn't reliable data, because obviously it gets revised later down the line. But can you comment on the latest number? And more importantly, I mean, does it even matter now? Or, I mean, are the markets completely focused on trade war narrative?
Well, I definitely think the market is totally focused on tariffs right now. Everybody's all concerned, and countries feel threatened or hurt from tariffs being slapped on them and things like that. So tariffs are definitely taking the front headline news. But economic data, I think, is important. I think unemployment rate has been rising. It's had a series of little bull flags. When you look at it from a big picture, it's pointing to much higher unemployment rate in the very near future. And I think this is one thing we've been waiting for. And I've been talking about this with the crude oil chart. Oil has been holding up above $65 a barrel. I said, if oil clearly breaks below $65 a barrel, that is a sign, I think, that we're going into like a global recession. And I said there'll probably be some type of economic news that changes the pivot, that pivots the market. And we've seen that. Now we got tariffs. We're probably going to see sales slow down, which means earnings slow down, which means investors sell stocks because the PE ratios won't be as good. And so all these things are coming about. So I think unemployment will creep up, and the macro picture to me is very bearish. A lot of people don't realize that. Like, I'm in Ontario, Canada, and I think the unemployment rate here is like 7.5%, but nobody's talking about it. It's high. Yeah. Things are not as rosy as people think in the news. I think a lot of the news on TV covers it up. And as you said, they revise numbers, they change the calculations of which data is even in it. So we don't even know how it compares to how it should have been based on old formulas that the Fed and government uses.
Right.
Canada had some crazy job numbers come out today that were not looking good either. Of course, Q1 just ended, so we should be able to, at the end of at least Q2, see what the effect of some of this tariff call is. I wanted to step back a minute, though, because you've been doing this a long time, Chris. How do you prepare as a technical trader for an environment like this where political shock is overtaking traditional economic signals, especially when Trump doubles down saying his policies will never change?
Well, I mean, you really have to try and filter out the news. Obviously, the political stuff, they are landmines. You don't know when one's coming, when it's going to go off, and how big it's going to blow off. So you just have to be very cautious. You have to manage positions. You need to. What I do is I follow trends. Typically, the market leads you to the data, leads you to the news. The charts have been pointing to this happening for the last several months. The market put in a major top. It's been selling off like the stock market for the past month and a half. It formed a very bearish chart pattern that pointed to an imminent sell-off this week. And then, the tariffs hit. So I've always found that the charts will paint the picture, And then news comes out, and then the rest of the picture's done from the news. And everybody's like, oh, well, that was a news-driven move. It was all, I'm like, no, it was already factored into the markets and the momentum. It was already set up. So you're best to follow price and not react to news. If you just follow.
Dude, this dude is just, if you don't get anything else out of this video, get that. This dude is speaking 100% fact. The technical setups always precede the news. Always. The technical setups always precede the news. So when you see a double top or a double bottom, full flag, or whatever the case may be, you see those things setting up, there will be news, there will be a catalyst to make the pattern play out. The inside guy, somebody always knows, first of all. Like, people talking about inside trading and stuff, that happens all day, every day. Somebody always knows what's going on and when it's going to happen. So these technical setups are happening for that reason, because the people who do know are positioning, getting in position for the news to get out. So you can call me crazy, you can say, oh, I'm talking crazy and no one knows. Trust me. You can go look this up yourself, do your own research, but somebody always knows what's going to happen and when the announcements are coming. So the technical setups are always preceding those news releases that are random. They're always preceding those. Mark my words. So you see a bull flag, then you'll see the announcement come out. You'll see a double top, then you'll see an announcement come up. The double bottom, then the announcement comes out. Make the pattern play out. So again, this dude, what he just said is absolute gold. When you see the setups happening, take it on for the technical reasons. Obviously, have your stop losses and things like that, but take it for the technical reasons. And usually, if it plays out, it's because some random news came out right at the level that it needed to come out at. Price just happened to be at a order block, or just happened to be at a support level when the news hit. How do you figure that happens? Right. We're obviously, this video is a little bit older, but tariff news comes out, or the president decides not to tariff countries and to put pause 90-day pause on it, right at the Fibonacci level that Chris was talking about, that we just charted. How do you think that happens? Why do you think news comes out perfectly at the measured move Fibonacci level? Like, this is not random. This is on purpose, and somebody always knows. And the people that actually control the market, the institutions and the insiders and things like that, they know this is happening. They're just trying to get the market now at a price where they want it to. It's up to us as retail traders to be able to understand, hey, price is at a big level, an inflection point, a point where institutions and big players and hedge funds probably want to buy at. And it's for us to get in, because that's the level where the news comes out. Hope you guys catch that.
Follow price, the news tends to fall in your favor. You don't know what it is or what's going to happen, but the news tends to follow the price, believe it or not. Absolutely. And the price paints the picture and the direction before the news comes.
Moves very quick, as we know in these times. Speaking of which, we got to talk about the Fed, because I was watching Jay Powell all morning. He was speaking at the Society for Advancing Business Editing and Writing annual conference. And Jerome Powell pointed out that tariffs are higher than all forecasters had predicted, and that the economic effects will include higher inflation and slower growth. But at the same time, the Fed chair stressed that the U.S. central bank will wait before making any rate changes, stating, quote, that it is too soon to say what will be the appropriate path for monetary policy. And following Powell's comments, the CME FedWatch tool is pricing in only a 35% chance of a rate cut in May. And overall, investors obviously are expecting 4 rate cuts this year, with the first one kicking off in just the summer months. First, I want to get your reaction on Powell's comments in this very volatile time, but how do you see them responding to the tariffs? Do you see a rate cut coming?
I don't know. I mean, inflation wants to linger around. I mean, if they cut rates, it's gonna hurt. Inflation's gonna hurt people more. I think the Fed is standing back. I think they're going to see this shock that's hitting the market right now, and they're like, "Whoa, this is way too much. Let's not throw another, something into the fire. Let's just let things simmer a bit and not look like we're reactive and that we're in control, and then we'll do something." Well, so I think they're just like, the market is a mess. It's haywire. Let's not poke it anymore right now. Yeah. And I think they're going to do something. I don't think they're going to drop rates very fast. If if inflation is here to stay and we're going to see things, I think we're going to have to still see more pain in the stock market for Main Street. I mean, yeah, it's been a big down move, but really in the grand scheme of things, I think there's a lot more downside. I think we have to kind of hit more so financial crisis level down maybe 25-30%, and this needs to drag out for a little while, and earnings need to slow down. Then we'll probably see the Fed say, okay, these companies need a break. The sales are down. We got to cut interest rates so that their borrowing costs drop and they don't have, all this overhead. So I don't think rates are going down anytime soon, which I do think they eventually will go down, but I do think we need more time. And I think the Fed's right. I think they need to hold off a little bit, save a bunch of those cuts to try to support the market later and let the noise get shaken out from the tariffs right now.
Hey, the financial crisis. I mean, you just talked about the financial crisis. And I mean, before I let you go, when we look at this at the longer term, I mean, how would you describe the moment in time? Because Japan's prime minister is calling it a national crisis as Tokyo suffers its worst 5-day run since COVID. Europe is pledging a huge response here. I mean, are we watching a geopolitical unraveling, or are we looking at a global trade reset? And, what does that mean?
I think it's a global reset. I think we're coming into when I say financial reset, I mean, I don't just mean in America. I think it's a global reset. I think that's why gold is done so well. I think people all around the world are nervous. People who have wealth want to move it into something that is somewhat stable and is outside of the financial system, because I think we're going to have a financial crisis. And so they moved to physical gold and silver. And that's why, gold is holding up so well, because, you're not going to lose 10% a day in gold. You can lose it in silver, but investors are savvy. They want to, if they have large wealth, they move it to something that is as stable as they can, that might not be wrapped up in stocks and the financial system and banking and all that stuff. So I think we are going into a crisis. I think, the market, the PE ratios are still way out of whack. Just because prices have dropped doesn't mean they're actually cheap. All people are doing who are still holding are just giving back gains that they've made over the years from what I think are overpriced stocks. And a reset is normal. A reset is an opportunity. The question is, are you going to avoid it? Can you benefit from it? Or are you going to ride it down? And most people don't know what to do. That's the whole reason why I try and share what I do, which is how to avoid these and understand when we're in a bullish environment or a bearish environment. There's times to be greedy and own stocks and ride a bull market up. And there's times when you really preserve capital and you have to protect. You never know which pullback is going to turn into the one that crushes your account, changes your projection on lifestyle. So that's what we need to be aware of, and always protect your capital by, if the trend turns down, just move to cash or something else. Could be the dollar index. Dollar's oversold. It's been beat up with tariffs. It's starting to come to life as you and I are talking today. I think when chaos hits, we tend to see the US dollar index do very well. And it just hit a major support level. The stock market just hit a major resistance level. Everything is hitting Fibonacci targets. So the market is actually playing out from a technical standpoint pretty crystal clear. And I track it every day and every week with followers and subscribers. And none of this is a huge shock to us. We've already been positioned. We're expecting it. We're waiting for a bounce, and then we'll be looking to play the downside on the next leg with an inverse ETF or potentially a different asset class. Could be the dollar, could be bonds. I don't know. It depends on how things move and when that trigger happens.
Yeah, good work. Okay, well, keep calm. Carry on. Appreciate it. Christopher Muehlin from the Technical Traders joining us. Great to see you, my friend. Have a great weekend, and hopefully all goes well on Monday.
Appreciate it. Take care.
Thanks, Chris. I'm Jeremy Safford. Thank you for watching. We'll continue to have and watch the markets here. And in the meantime, give us a like, subscribe, and tap the bell so you're the first to catch the next big move. More at kitco.com. See you next time.
Yeah, check out Kitco News. They're pretty good. They have some really good interviews that they do. Some guys are just, saying that the world's coming to an end, but every once in a while they'll get a guy like Christopher Million who's actually really good. Good technical trader. Perfect timing because the freaking lawn care guys are coming through, so perfect time to end the video. But hope you got something out of this. Again, remember Warren Buffett always says, "Be greedy when everybody's fearful, and be fearful when everybody's greedy." So that's what you saw. That's what you saw on these charts, right? Let me pull that up one more time. That's what you saw. You saw people getting greedy up here when they should have been getting fearful. They should have been getting out. But now people are going down here and they're getting fearful when this is where they should be getting in. Okay? So you don't want to be greedy up here. You don't want to be fearful up here. The opposite. Fearful up here. Start trimming your position. start going mostly cash. Then when you get down here, all right, now it's time to start buying some stocks, start deploying some capital, time to start getting in a position. This is how the game is played. So don't be liquidity, as they say. Don't be the guy buying the top and shorting the bottom. Don't be that guy. And manage your money. The number one rule in investing is don't lose money. So as long as you do that, you'll be okay. But anyway, like and subscribe to the video. That's my analysis for today. If you like it, give me a holler. Go in the comments. Let me know what you think. Let me know if there's any other videos. Send them to me or DM me if you think there's some better or other videos I should do some analysis on. But this is what I love. This is what I like to do, and I think we're in for a crazy ride in this market. So again, like and subscribe, and I'm out. Thanks.